Good morning, students. Welcome back to the session on advanced accounting. So today we plan to continue with our discussion on the consolidation. In the previous session, we discussed certain concepts around consolidation that was in relation to subsidiary, for which the relevant accounting standard was AS 21. Okay, so today we plan to continue with that, and hopefully we'll also be starting the consolidation requirements in respect of joint ventures, okay, which comes through the requirements of AS 27. In respect of consolidation, as we have discussed, there are three accounting standards. One is AS 21 dealing with subsidiaries, other one is AS 27 dealing with joint ventures, third one is AS 23 dealing with associates. So, all of these three accounting standards are all about consolidated financial statements only. Yeah. So let's see as to how things progress today, and accordingly we'll move on to the next accounting standard also. So quickly talking about consolidation. In terms of consolidation, we discussed that whenever a company will have a subsidiary, consolidation becomes mandatory. So in case of consolidation, what is required? Standalone financial statements will be prepared by both the companies. Over and above that, both the companies will also be required to be considered as a group, wherein their financial statements, means combined financial statements, wherein both the companies will be considered as a single entity, and accordingly their consolidated financial statements will be prepared. Yeah, for which we discussed some of the consolidation adjustments. So today we are going to continue with all of those consolidation adjustments. Goodwill capital reserve we discussed is required to be computed in case of consolidation. So now let's quickly look at some of the procedures which are required to be looked at whenever consolidation will be required. So one will be about the computation of goodwill or capital reserve. Okay. Yeah. So something that we have discussed. Now, in respect of consolidation, at times it may also happen that the companies within the group which are going to get consolidated, they may have some transactions with each other, okay, which is called as intra-group transactions, means transactions within the group, transactions between those companies which are going to be consolidated. Such transactions are required to be eliminated while preparing consolidated financial statements. So we'll discuss this as to how this elimination will be performed. Then, in respect of this elimination, at times it may happen that the companies which are transacting with each other within the group, they have got some unrealized profits. Okay, and that is again in respect of intra-group transactions. So those profits are also required to be eliminated at the time of preparation of consolidated financial statements. So this again will talk about minority interest. We discussed, so whenever holding company will not acquire 100% shares, so what will happen? One of the minority shareholder will be there. That minority interest, okay, is required to be computed, and that will also be presented in the consolidated financial statements. Next is about the reserves. So both minority as well as majority shareholders, they will have some interests in the net assets, in the reserves. So at the time of preparation of consolidated financial statements, both of them are required to be picked up. Okay, so we can just broadly say that these are the consolidation adjustments which are required to be looked at whenever consolidated financial statements will be prepared. Okay, now goodwill and capital reserve we have already discussed. We have already looked at some of the questions around it, minority interest, profit or losses of subsidiary, and in respect of revaluation also. Okay, if you remember, we discussed that whenever the subsidiary company will be taken over, it may happen that the holding company decides to revalue some of its assets, okay, or decides to make some adjustments in the liabilities in respect of some assets at the time of takeover. So whenever consolidated financial statements will be prepared, so what do? you will pick up those adjusted numbers. You will pick up those adjusted numbers. Now, moving further on to one of the important adjustment, which is in relation to dividends, which are distributed by the subsidiary company. Now, there is a concept which is called as pre-acquisition dividend, post-acquisition dividend. We'll talk about those adjustments now. Okay. So before that, I can see one query coming from Srinivasan. He's asking, sir, if intra-group transactions are eliminated, why we need to consider transfer pricing and its importance? That is because of the fact that intra-group transactions or intercompany transactions are eliminated while preparing consolidated financial statements only. In the standalone financial statements of each company, those transactions continue to remain. Okay. Yeah. So that's why this transfer pricing or all of these taxation provisions, where are they relevant? Where are they applicable? At the standalone level. Understood? All right. So now let us just move on to pre-acquisition dividend and post-acquisition dividend. Now there is a concept of pre and post-acquisition dividend, which I would say is important for the purposes of preparation of consolidated financial statements. So let's quickly understand as to what is this concept and how is this required to be adjusted. So say there is a company which has been taken over on 5th of June 2024. Okay. So a company has been acquired on 5th June 2024. And who acquired? So say P Limited acquired Q Limited. Okay. Now, if we look at the financial year, then of course this acquisition has taken place during the year. Okay. But for the purposes of preparation of consolidated financial statements, what do we need to look at? We need to look at the cutoff, means this cutoff, when the acquisition has taken place. So any of the reserves of Q Limited which pertain to this period means prior to acquisition, any of the reserves of Q Limited prior to acquisition, what do you call it as? That is called as pre-acquisition profits or pre-acquisition reserves. Similarly, if you look at this period, okay, so this period is what? Post-acquisition period. This period is post-acquisition period. So any of the profits which Q Limited will earn after 5th June will be what? That will be post-acquisition profits or the post-acquisition reserves. Okay. Now, in relation to this pre-acquisition and post-acquisition, a concept around the dividend is also required to be considered. Now, what is that concept? Say, for example, if on this particular date, okay, subsidiary gives dividend. Let's suppose subsidiary distributes dividend on 5th June. So can you tell me from which profits this dividend will be distributed? Means when this dividend will be distributed by subsidiary, so what is going to be the source of this profit or the reserves? Where does it come from? Which period would it belong to? Can you tell me? Over to you. Can you tell me which period would it belong to? So I think Aditya has answered this. Aditya is saying it will come from pre-acquisition. Yeah, which I think is very, very clear to everyone. So whenever any dividend will be distributed over here, yeah, whenever any dividend will be distributed over here, so it will be very easy for us to understand that such a dividend will be paid out of the profits of this period only. Yes or no? Yeah. And therefore, such a type of dividend is also called as pre-acquisition dividend. Or you can say dividend distributed out of pre-acquisition profits. In relation to this dividend should not be taken to P&L. Instead, it should get adjusted with the cost of investment of P Limited. Okay, so pre-acquisition dividend, where do you adjust it? Cost of acquisition of P Limited. We'll understand with the help of examples as to how do you adjust it. Okay, now there is a confusion which is going to arise when the dividend, let's suppose, is distributed on 31st March 2025. Okay, now on this particular date, 31st March 2025, if let's suppose dividend is distributed, now there is going to be a confusion. Now what is going to be the confusion? Now we need to find out that if this dividend is distributed, where does it come from? Okay, which means whether it comes from this particular period, or whether it comes from this particular period, or whether it comes from this entire period. Okay, so now this is something which is required to be looked at. Why? Because depending on the profits or the reserves, where it comes from, what will happen? Its accounting will change. So every time a dividend is distributed, what is it that we need to look at? We need to look at whether it's going to be pre-acquisition or post-acquisition. Because if it is pre-acquisition, so what will be the accounting treatment for this? It will get adjusted with the cost of investment. Understood? It will get adjusted with the cost of investment. Okay. Now, to discuss this, we'll take some examples. And before that, I'll just quickly take you through a quick snapshot of the accounting treatments also. So if in case there is a post-acquisition dividend, post-acquisition means which is paid out of post-acquisition profits. Now, how do you deal with that? If that is accounted for by the subsidiary, no adjustment is required. If not accounted for by the subsidiary, then that is required to be adjusted, of course. In the books of holding company, that is accounted by crediting P&L. Yeah. Why? Because it will form part of income of the holding company. So I think post-acquisition is perfectly all right. Quite simple. Important thing is to understand the treatment of pre-acquisition dividend. Now, as regards pre-acquisition dividend means dividend which is paid out of the profits prior to acquisition, or of that period which belongs to pre-acquisition. Now, if in case this is accounted for by the holding company, okay, if this is correctly accounted for as a reduction to the cost of investment, do you need to do that thing? But if this has not been adjusted, or if this has been wrongly taken to P&L, this should not go to P&L. So what do you need to do? You need to adjust this with the cost of investment. You need to adjust this with the cost of investment. So if no entry is passed, adjust this with the cost of investment. If a wrong entry is passed, of course, you will rectify. How do you rectify? By adjusting with the cost of investment. Okay. Then I think Nistala is saying, sir, please explain this concept with an example. Yes, we'll discuss examples, but let's try to understand the concept first, and then we'll pick up examples also. discussed as how this is required to be adjusted. So now let's move on to some examples to discuss the treatment of pre-acquisition and the post-acquisition dividend. So let me just pick up some examples now. Just give me a minute. All right. So now from the following data, you are required to determine in each case. Just a minute. I think I have picked up the wrong example. Just a minute. All right. So let's look at this example now. So XYZ purchased 80% shares of ABCC on 1st of January 2000 X1 for rupees 1,40,000. Issued capital of ABCC on 1st of January X1 was 1 lakh. Okay. And the balance in the P&L was 60,000. So now can you tell me in this example, will there be any minority interest or not? Over to you. Quickly, do you think there will be any minority interest in this example or not? Over to you. Quickly, I'm waiting your response. Yes, quickly, please confirm. Yes or no? So Pratika is saying yes, Sila is saying yes. I can also see some of the queries coming in as on the audio. So is the audio clear? I think Nisar or Ajit, you can also confirm. Is the audio clear? Okay, great. So the queries were coming in. Right. All right. So now, as you already mentioned, I think Rashmi and they have answered, this has answered that minority interest is going to be there. Now, in this example, if we move further, okay, so on 1st of January, this acquisition was taken place. If we move further, means during the year ended 31st December 2000 X1. So this was the calendar year. ABC Limited earned a profit of 20,000. Okay, and at the year end declared and paid a dividend of 15,000. So now during the year, ABC has earned a profit of 20,000. Who is ABC? ABC is going to be the subsidiary and paid a dividend of 15,000. Show by an entry how the dividend should be recorded in the books of parent company. Okay. Now, what is going to be the amount of minority interest as on the date of acquisition? Also, you need to compute this amount as at the reporting date. Okay. So there are two things. One is the accounting treatment of this dividend, which is paid by the subsidiary to the holding company. Second, minority interest on the date of acquisition, minority interest and the as at the reporting date. Also, please check whether there should be any goodwill or capital reserve. Okay, so in this question, three things are required to be computed. One is treatment of dividend. Second is minority interest. Third is goodwill or capital reserve. So I have been constantly receiving the queries from some of the students. Nisar, if you could please check, because students are constantly saying that the audio is not clear. Is it all okay? Nisank, if you are around? Yeah, sure. You may confirm once you are through.
आचल जी ऑडियो एकदम बराबर है।
Okay, so maybe students
जी
are
सर,
facing some
को
problem at their
इतना
end.
समय क्यों लगता है करने में? नहीं, स्टूडेंट्स तो देखो, दे आर दे एक्सपेक्टेशन मून।
I can understand, sir. Sure. So I'll continue, sir. Yeah.
आचल जी, यू आर टेकिंग इंटर और फाइनल?
Inter, sir, currently.
So this question, instead of 1st January, if it could have been 1st April, and instead of 31st December, 31st March, because we follow the fiscal year. This question is more on an UK or American question where they follow calendar year. Asha ji,
Yes, sir.
we must take care of all this.
Yes, sir.
And we must expedite 10 model paper, Asha ji. We have been working for 15 years, 20 years. And kindly coordinate with other faculties of Inter, because September 24 we have exam. So I am now focusing on foundation. And from 26th June, every day we want a webinar for intermediate. We want to see that 100% result comes, आशा जी.
हाँ जी सर.
तो आप लोग हम सब मेहनत करेंगे तो रिजल्ट होगा ना. कैरी ऑन अचल जी, कैरी ऑन.
Sure. Okay. All right. So we discussed the question. In this question, three things are required to be computed. One is on the dividend. The other one is the minority interest. And third one is about the goodwill or capitalism. So now in this example, before I really move further, can you just quickly tell me how should the holding company account for this dividend? Over to you, everyone. Please confirm. Yes. In respect of this dividend, which has been distributed by the subsidiary company ABC, can you tell me how should this be accounted for by the holding company? Yes, I'm waiting for a response now. Everyone quickly. What should be the accounting treatment of this dividend in the books of holding company? Means XYZ. Yes, everyone. There are a couple of adjustments we discussed, whether it should go to cost of investment or whether it should go to the P&L. Okay, and that will again be dependent on the period to this or to which this dividend would belong to, or you can say the period for which the profits would belong to. Accordingly, this accounting treatment should be taken. So Rashmi is saying this should be adjusted with the cost of investment. Pooja is saying this will go to profit or loss. Then I think Rashmi has answered this. What about others? Quickly, huh? What do you think? Okay, Sangeet Pani is saying this should get credited to P&L account. So can you also give me the rationale as to why it should go to P&L or why it should go to cost of investment? Quickly, everyone. Yes, I'm waiting for responses. First, whether it should go to P&L or the cost of investment, and why. Why do you think it should go to P&L? Why it should go to cost of investment? Over to you quickly. Okay, so I can see some more responses coming in. Nistila is saying post-acquisition dividend. So it's for the period which is post-acquisition. So that's why it should go to P&L. Harish is also saying it should go to P&L. Okay, so Pooja is saying it is post-acquisition period. So that is why it should go to P&L. And I think this response comes from Rashmi. Rashmi is saying because it's the pre-acquisition period. So that's why it should go to cost of investment. All right. So Srinivasan is saying, okay, so Srinivasan is just talking about the concept. No, I want a specific answer in relation to this. So let's move on to the solution now. Let's try to understand as to how this should be treated. Okay, so now moving on to the solution around this. In the meantime, I can see Sento is saying, sir, it will be recorded in the P&L as it is for the post-acquisition period, and therefore it should get credited to the income. All right, so let's move on to the solution now. Same is the response from Sitkala. All right, so now if we look at the dividend, now in relation to the financial year that we have, okay, which is about the calendar year. So now what do you find? That this dividend has been declared at the end of the year. Okay, so this is the end of the year. And when the dividend is declared at the end of the year, and when the company has also earned sufficient profits during the year, so this is the amount of profits which the subsidiary has earned. And out of these profits, if the dividend has been declared, what do you call it as? What do you call it as? So this period is what? Post acquisition. Yeah. So any dividend which is paid out of post acquisition profits, how is that required to be treated? That will not get adjusted with the cost of investment. That will go to the profit and loss account. So that's why in this example, it's going to be very simple. Okay. So the accounting treatment in the books of XYZ is going to be very, very simple. So what is the accounting entry XYZ will pass? So XYZ will say that bank is debited. Okay. And why is the bank debited? Because this has actually been received. And of course, P&L will get credited. So P&L means the accounting treatment requires this dividend to be taken to the profit and loss. Okay. And in relation to this amount of 15,000 dividend, out of 20,000, 15,000 is the amount of dividend. Now, please remember, entire amount doesn't belong to holding company. Why? Because holding company holds only 80%. Okay, so that's why only 80% is the amount which pertains to holding company. So that's why what is going to be the amount which holding company will record in its financial statements? That means in the consolidated financial statements. It's going to be 12,000. So that means 80% of the amount distributed as dividend. Yeah. Now, moving further and continuing on this, can you now also tell me what is going to be the amount of minority interest? Yes, over to you. What is going to be the amount of minority interest at the time of acquisition as well as at the reporting date? We discussed some examples around minority interest in the previous session. And also, if you could just let me know the amount of goodwill or capital reserve. So are you getting goodwill or capital reserve? I think it's fairly easy for you to compute. Yes, over to you. One, goodwill or capital reserve. You can just compute and let me know the answer. And second, minority interest. Okay, on both the dates, at the time of acquisition as well as at the reporting date. Yes, over to you. Over to you quickly. goodwill and capital reserve is first you need to compute. I think Nistala has solved this 4,000, but what is this amount? So is it about goodwill, capital reserve, minority interest on the reporting date or at the time of acquisition? Please clarify. So the question is there in front of you. I expect everyone to solve this quickly and start sharing your answer once you are done. Quickly. First of all, I think you can compute goodwill or capital reserve. Then you can just let me know the amount of minority interest on the date of acquisition and then the balance of minority interest as at the reporting date. Quickly, then I'll also move on to the solution. What is going to be the amount of minority interest? What is going to be the amount of goodwill or capital reserve? All right, so I think Rashmi has solved this. Rashmi is getting goodwill of rupees 60,000. So I'll just note down this response. Goodwill 60,000. Okay. So Srinivasan is saying goodwill 12,000. Okay. So I've got a different answer from you. What about others? Quickly, huh? First, you can just tell me whether you're getting goodwill or capital reserve, and then of course you can just let me know the amount. I can see two responses so far. Harish is getting a goodwill. Okay, great. And Harish has also saw. Okay, so Harish is saying goodwill 12,000. Okay, and Harish is saying minority interest 32,000 at the time of acquisition, 33,000 as at the reporting date. Quickly, huh? Then I'll also move on to the solution. Okay, so Aditya is also getting a goodwill of 12,000. Okay, great. So goodwill seems to be, computed in a way that most of you are getting same answers, except one, of course. What about a minority interest? What about minority interest? Okay, Sento has also computed. Sento is also getting a goodwill of 12,000. Very good. What about others? Quickly. Done. So let's get to the solution now. Now, in respect of this, please remember that XYZ acquired the company at 1,40,000. Okay. Yeah. And on the date of acquisition, share capital was 1 lakh, P&L was 60,000. So the cost of investment was what? 1,40,000. Or you can say in a way, this was the purchase consideration. Now from the purchase consideration, what do we need to reduce? Net assets. From the purchase consideration, we need to reduce the net assets. So now what is going to be the amount of net assets? So now the amount of net assets is going to be the total of share capital plus profits. So that means 1 lakh is the profit. Sorry. Now 1 lakh is going to be the share capital and 60,000 is the profit. So if we add these two, what do you get? You get the net assets. Okay. So if you add these two, you get net assets. Now proportionate amount of the net assets is going to be what? 1 lakh into 80%, 80,000. 60,000 into 80%, 48,000. Yeah. So the total becomes 1,28,000. Now, whenever the purchase consideration is more than the amount of net assets which have been acquired, what do you get? Goodwill. What do you get? Goodwill. Yeah. So in this example, the purchase consideration is more. Purchase consideration is more as against the amount of net assets which have been acquired. So that's why, what do we have? We have goodwill of 12,000 in this example. Okay. Then I see one more response coming from Nistala around minority interest. No worries. So let's move on to the minority interest. Now, what is the amount of minority interest? Minority interest means the minority interest holders, means those 20% shareholders, their share into the net assets of the subsidiary. Now, what is the amount of net assets of the subsidiary at the time of acquisition? At the time of acquisition, the amount of net assets we just compute, it's 1,60,000. So for the purposes of computing of minority interest, what do we need to do? Simply pick up the proportionate share of net assets. So what is going to be that amount? 32,000. Okay. Now, as we move further, means from the acquisition date, when we go up to the date of reporting. So now, when we started off, what was the amount of net assets? It was 1,60,000. It was 1,60,000. Now, how will the amount of net assets increase or decrease? On the basis of profits or losses during the year? Yeah, as far as the information is concerned in the question. So now, if we have to find out the amount of net assets as at the date of reporting, so what do you need to do? To these profits which were there at the time of acquisition in the form of reserves, and to the share capital, or you can say to these net assets, you need to just simply add the profits for the year. So that means to this 1,60,000, what do we need to add? We need to add the profits for the year. Yeah. So this profit was 20,000, out of which 15,000 has already been distributed. So that's gone. So what is it that is left? It's 5,000. Okay. And the proportionate share to that. Why proportionate share? Because minority interest holders hold only 20%. So that's why, what is going to be the balance of minority interest as at the reporting date? It's going to be 33,000. Okay. Yeah. So I'm hoping that Nistala, you are clear on this. Srinivasan is asking, sir, why company needs to find out minority interest at the time of acquisition and at the date of balance sheet? Because when you perform the consolidation, holding company picks up assets and liabilities of the subsidiary company on a line by line basis. Okay, and all the assets, all the liabilities are picked up 100%. Okay, assets and liabilities are not picked up proportionate, they are picked up 100%. So if let's suppose 100% assets have been picked up, or you can say 100% net assets have been picked up. Why? Because that is the consolidation procedure which is required to be followed in respect of a subsidiary company. So what is it that you need to do? So in such a case, you need to set aside an amount which belongs to those minority shareholders. So when 100% is picked up, so out of those 100%, in the financial statements, what do you say? That 20% belong to minority. So that is how it is presented separately in the financial statements. Okay, clear on this? Yeah. Nistla is asking what will happen to 1,40,000? Nothing. That is paid. That is cost of investment. That is already used for the purposes of computing goodwill or capital reserve. Yeah. All right. Any more questions on this? So now we'll pick up one more example. Okay, just give me a minute. All right, so let's look at this example now. X Limited acquires 70% of equity shares of Z Limited as on 31st March X1 at a cost of 70 lakhs. So what do you mean by this cost of 70 lakhs? I mean, this is the amount paid for acquiring this interest. And this interest is what? This is again not 100%. So that's why minority interest is going to be there. The following information is available. Following information is available from the balance sheet of Z Limited. So we are given the balance sheet of Z Limited. Please remember, it's only the balance sheet of Z Limited is available. It's not the financial statements. Okay. So PP is there, investments are there, current assets, loans, advances, debentures, current liabilities. Then it says the following revaluations have been agreed upon. Means when the assets will be taken over, so the PP needs to be revalued by 20%, so it will go up. Investments need to be revalued by 10%, so they will go down by 10%. Z Limited declared and paid dividend on its equity shares on 31st March X1. Face value is what? Rupees 10 per share. Further, X Limited purchased the shares of Z Limited at the rate rupees 20 per share. Okay, yeah. So this is the amount at which the shares of Z Limited have been purchased. Now, in this example, you are required to calculate goodwill or capital reserve. Yeah. In this example, you are required to calculate goodwill or capital reserve. So now in this example, there are effectively, you can say, 3 adjustments which we will be required to deal with. What are those adjustments? One is, of course, computation of this goodwill or capital reserve, for which revaluation will have to be dealt with as to whether it is going to have any impact on the goodwill or capital reserve, and dividend will have to be calculated, whether that will have any impact on the goodwill or capital reserve. Now, before I really move on to the solution, quickly, if you can just let me know whether this revaluation will have any impact on the goodwill or capital reserve or not. Yes, over to you, and tell me why. Whether this goodwill or capital reserve will have any impact on the whether this revaluation will have any impact on the goodwill or capital reserve or not, and why? Quickly. And in the meantime, I would suggest you can also start solving goodwill or capital reserve. I think Nistala is saying cost of capital less net assets acquired. So Nistala has shared the formula. Sure. But you should share the amount of goodwill or capital reserve if you have started solving this, which you should do. And also answer my question. Rashmi is saying yes, that will get impacted. Okay, what about others? Sento is saying yes, adjustments will have an impact on the goodwill or capital reserve. Unni Krishnan is also saying the same thing. Okay, now, can you also tell me about this dividend? Now, please remember that this dividend has been declared and paid on 31st March X1. On 31st March, and please remember that this subsidiary was also acquired on this particular date, 31st March X1. So can you tell me that whether this dividend will have any impact on the computation of goodwill or capital reserve or not? Yes, whether this dividend will have any impact. Pooja is saying yes. What about others? I'm talking about dividend. Okay. So with this dividend, will that be impacted? Aditya is saying no. Because of dividend, goodwill or capital reserve will not be impacted. I think Sento answered for the revaluation. But quickly, for this goodwill or capital reserve, you need to tell me whether dividend will have an impact or not. See, conceptually we have discussed this, so I just want to understand whether you have got this clarity of the concept or not, and then we'll get on to the solution also. Nestle is saying no, this will not have any impact. Okay, what about others? What about others? Quickly, will this have any impact or not? Yes. Sento is saying, so Sento, I'm not sure whether you have answered this as yes or no. Quickly, Pooja is saying no. Sento is saying it will not have any impact. All right, great. So let's get on to the solution now. So now, if you look at the revalued assets, so I think post revaluation, what is going to be the amount of the assets? PP will go up to 144. Investments will go down to 49.5. Current assets remain same. Loans, advances remain same. Liabilities remain same. So what is going to be the amount of net assets after adjustment of all of these revaluations? It will become 138.5. Okay, so this is the amount of net assets. Fine. Now, moving further on this, the amount of purchase consideration which has been paid was what? Amount of purchase consideration paid to acquire was 70 lakhs. Okay, now from the purchase consideration, what do we need to reduce? From this 70 lakhs, we need to reduce proportionate share of net assets. So that is how you calculate goodwill or capital reserve. Yes or no? That is how you calculate goodwill or capital reserve. Okay. So now in this case, proportionate share of net assets is what? 70% of net assets. 70% of net assets. So that means 96.5. Now, I think the point that we need to understand here is whether the dividend which has been declared by the subsidiary company will go to the P&L of the holding company or will get adjusted against the cost of investment. Now, if you look at that dividend, so that dividend has been declared and paid at the end of the year. Okay, on 31st March, this has been given. And when did the acquisition take place? Acquisition also took place on same date. So which means that this dividend has been paid out of the profits prior to acquisition. So what do you call this dividend as? Pre-acquisition. So if there is a pre-acquisition dividend, where will you treat this? Where will you take this? So that will go to the cost of investment. Yeah. So that will go and get adjusted with the cost of investment. Yeah. So my cost of investment will go down by the amount of dividend. So if my cost of investment will go down, will that have any impact on the goodwill or capital reserve or not? Yes, of course. Yeah. So now my cost of investment, instead of 70 lakhs, what does it become? It becomes 63 lakhs. So that's why, will it have any bearing on the goodwill or capital reserve? We can see yes, it has a bearing on the goodwill or capital reserve. Okay. Now, the next aspect is about the computation of dividend. I think that is fairly simple. So what do you need to find out? You need to find out the amount of dividend. So dividend has been declared at the rate ₹2 per share. So how do you get this? So this information is given in the question. So it says dividend has been paid at the rate 20% when the face value is 10 per share. So that means ₹2 per share is the amount of dividend. Now, how many shares are there? Total capital was 70 lakhs. Total capital was 70 lakhs. Means the amount which has been paid. And for one share, 20 rupees has been paid. So how many shares are there? 3.5 lakh shares. 3.5 lakh shares. So 3.5 lakhs into rupees 2 per share is going to be the amount of dividend. So that means it will become 7 lakh. And this 7 lakh, because this is pertaining to which period? Because this is pertaining to the period which is prior to acquisition. Okay. Period which is prior to acquisition. So that's why it will go get adjusted against the cost of investment. Okay. So accordingly, what do you get? You get capital reserve over here. Okay. Yeah. I think Sitkala answered this, that this should get adjusted against the cost of investment, and same was the response from Pooja also. Very good. Srinivasan is asking, sir, X Limited purchased the shares of Z at a premium. Why this premium is not considered in calculating purchase consideration? So this has been considered. So in the purchase consideration, we have picked up this total amount, 70 lakhs. We have not removed any premium. Okay. Yeah. So entire amount has been considered. Full 70 lakhs has been considered. All right. Yeah. Any more questions? Any more doubts if you have on this? Yes, quickly. Any more questions? Any more doubts if you have here? No? All right. So let's move further. Now we will be discussing some more adjustments around the consolidation. So I think Nistala has a query. Nistala is asking, sir, please explain dividend calculation. Very simple. Huh? So dividend is declared at the rate 20%. Okay. So on shares which have a face value, just on shares which have a face value of rupees 10, if the dividend is declared at the rate 20%. So what does it mean? This into 20%. So this will become rupees 2 per share. This will be rupees 2 per share. Okay. Yeah. I think same was the query from Sangeetvani also. Sangeetvani is asking how to find dividend of rupees 2 per share. So this is how you'll find. Okay. Clear? Now, moving on to the next point, and that is about intercompany eliminations. Now, what do you mean by intercompany eliminations? What are these adjustments which are required to be looked at in respect of intercompany eliminations? How do you deal with them? How they will have an impact on the consolidated financial statement? So some of these aspects we are going to look at now. Now, intercompany elimination means elimination of the transactions and the balances which have taken place between two companies within the same group. So say there is H Limited and S Limited. Okay, so these are the two companies, H Limited and S Limited. And these are going to be consolidated. So let's suppose during the year, H Limited had sold goods worth of rupees 1 lakh. Goods worth of rupees 1 lakh to S Limited. Now, how would have S Limited recorded this? S Limited would have considered this as purchase. And H Limited would have considered this as sales. Means in the books of H, this would have been appearing as sales. In the books of S, this would have been appearing as purchase. Now, when the financial statements of H and S will be prepared, means consolidated financial statements. If you look at the P&L, in the P&L, what will happen? Out of the total sales of both these entities. So when you consolidate, what do? You do line by line addition. So let's suppose H had a turnover of 20 lakhs. S had a turnover of 10 lakhs. So all in all, this amount would have become 30 lakhs. Yeah. Similarly, if you look at purchases, let's suppose H had purchases of 15 lakhs. S, let's suppose, had purchases of say 10 lakhs. So in total, this would have become 25 lakhs. Total, or you can say the one which belongs to the group. Now, if there is any sale, or if the financial statements of this group will be looked at, in this sale of 30 lakhs, sale which has taken place between H and S is also included. So do you think it will be appropriate for the group to show any sales, any transactions which have taken place within the group? What do you think? Over to you. What do you think? Will it be appropriate to continue to, or to let those items remain, or let those transactions remain, or let those balances remain in the financial statements of the group? Yes, what do you think? Will it be appropriate? Tell me. Pooja is saying no. That should not be done. Yeah, that should not be done. So that's why in this example, what should you do? In such a case, what should you do? In such a case, what should you do? Tell me quickly. In such a case, what should you do? Should you let those transactions or the balances remain? No. So Pooja is saying no. Rashmi is saying no. Aditya has got the same answer. So that's why when the group's financial statements will be prepared, so such transactions are required to be eliminated. So that means this elimination column will have to be brought in. Basis which, what will happen? Out of the total sales, 1 lakh will be reduced. Out of the total purchases, 1 lakh will be reduced. So that the amount that we get after adjustment, will be 29 in this case and 24 in this case. And this will be the right representation of the numbers to be reported in the consolidated financial statements. Okay. But this adjustment that we have discussed is quite simple one. So idea was to just to give you a conceptual clarity that any of the transactions which have taken place within the group, they need to be eliminated. Okay, they need to be eliminated. Now, every time whenever we will get into any transaction, we will have to find out if any such adjustments are there or not. Now, in respect of this, another part becomes important. Let's suppose H sold goods to S, say worth of 20 lakhs. Okay. Now, in the P&L, you will eliminate this. Why? Because this is intra-group. So at one place, sales will be reduced. At another place, purchases will be reduced. Okay, so this will get reduced. But its corresponding impact will also go to the balance sheet. This will also go to the balance sheet. So what will happen? In the financial statements of S Limited, when you look at the inventory of S Limited, inventory of S Limited would also include this 20 lakhs. See, sales and purchases have been eliminated. That is fine. But what about balance sheet? So in the balance sheet, there is an inventory. There is an inventory of S. Now let's suppose if this sale would not have taken place, Let's try to understand this. Let's suppose if this sale would not have taken place between H and S, then this inventory would have been outstanding in the books of H. Then this would have been outstanding in the books of H instead of S. Currently, it is outstanding in the books of S. But when you prepare the consolidated financial statements, does it really matter? No. Why? Because H and S, they will be considered as if it's one entity. Okay. So as far as this inventory is there is absolutely no problem. Why? Because in the CFS, inventory has to be there at 20 lakhs. But there is one problem which is required to be looked at. What is that problem? When H would have sold this inventory to S at 20 lakhs, this would not have costed only 20 lakhs to H. Let's suppose its cost was what? Its cost was 15 lakhs. Okay, so its cost was 15 lakhs, which has been sold by H to S at 20 lakhs. Now, let's try to again understand its impact. If let's suppose this transaction would not have taken place, this inventory would have remained in the books of H, but not at 20. At what amount? This would have remained in the books of H at 15 lakhs. At 15 lakhs. Currently, just by making a transaction within the group, a profit of 5 lakhs, a profit of 5 lakhs has been recorded by the group. I'm not saying by H or S, by the group. Is that profit appropriate? No. So that is a profit which has been generated within the group. That cannot be recorded in the financial statements of the group. So that's why every time there is any such transaction, what do you need to find out? You need to find out that if such sale or purchase has taken place, whether the inventory is still outstanding or not. If the inventory is still outstanding, then on this inventory, there must be a profit. And what do you call this profit as? Unrealized profit. This is called as unrealized profit. Such unrealized profit is required to be eliminated. Why? Because this profit has been generated within the group, not outside the group. Now, what do you mean by outside the group? Let's try to understand this. Let's try to understand what do you mean by outside. Just give me a... So now, let us suppose H sold goods to S at 20 lakhs and S in turn has sold these goods outside group to say ABC Limited at 25 lakhs, 30 lakhs, 21 lakhs or at a loss, doesn't matter. Now, in this case, there is no inventory which is outstanding as at the reporting date. So that's why this profit, or you can say out of the total profit which would have been generated, let's suppose this 20 lakhs has been sold at 22. Now, in this case, there are two parts of the profits. One which has been generated within the group and second which has been generated outside the group. But all in all, this entire profit is coming from whom? ABC. Because eventually this has been, if this has been sold to ABC, so that means the group has realized a profit of 7 lakhs. An item which had a cost of 15 lakhs that has eventually been sold at 22 lakhs. So the group has realized a profit of 7 lakhs. So if the profit has been realized, How do you get to know whether the profit has been realized? When the item is fully sold off, there is no outstanding balance, there is no closing balance. In such a case, this problem of unrealized profit or elimination of unrealized profit will not arise. That will not arise. Why? Because there is no unrealized profit as such. But whenever such a sale has not taken place, and when the inventory is there as at the year end, then there is an element of unrealized profit which is required to be eliminated at the time of preparation of consolidated financial statements. Okay, clear on this? So this is an adjustment which is required to be done. So let's look at one example now to discuss this. Just give me a So let's look at one example now. And in this example, we'll discuss this treatment of unrealized profit. A Limited holds 80% share capital and voting power in B Limited. So that means A Limited is the holding company. A Limited sells inventories costing 1.8 crore to B Limited at a price of 200 lakhs. The entire inventories remain unsold with B Limited at the end of the financial year. Okay. Now, looking at this first situation first, please ignore part B. We'll look at only part A to begin with. Okay. Now, you are required to suggest accounting treatment for the above mentioned transaction. Now, in relation to this transaction A, what do you think should be the accounting treatment? Over to you. Quickly. We just discussed this. What do you think will be the accounting treatment? Over to you. Yes, tell me. How should this be treated? Do you find anything which is in relation to transaction within the group? Intercompany transaction? If there is anything around elimination, how that elimination should take place? Over to you, quickly. Yes. How should this elimination be done by the group companies? Yes, over to you. Waiting for a response, huh? A Limited and B Limited have entered into a transaction on which there is a profit. Sitkala is saying that it's a intra-company transaction. So I would say this is intercompany transaction. Okay. All right. So Nistala is saying 20 lakhs is the profit. All right. So what do you need to do this? In respect of this 20 lakhs profit, what do you think needs to be done? Sangeetwani is saying 20 lakhs is the unrealized profit. Kiran is saying this unrealized profit of 20 lakhs needs to be eliminated. Yes or no? Yeah. So in this case, there is a profit element of 20 lakhs. And because this entire inventory is unsold, so that's why, what is this profit element? This profit element is, of course, unrealized. This is unrealized. So this will have to be eliminated. This will have to be eliminated at the time of preparation of consolidated financial statements. Okay. So I think this part is clear to everyone. Yeah. So now let's try to understand as to how do you eliminate it. Now in this example, goods have been sold by holding to subsidiary. So whenever goods are sold by holding to subsidiary, what do you call it as? A downward transaction. Okay. So you can say something like this. So this is holding and this is subsidiary. So this is sold by holding to subsidiary. You can just simply say it's termed as a downward transaction. Now this profit of 20 lakhs would have been booked by whom? H Limited. This would have been booked by whom? H Limited. So that's why what would H Limited do at the time of preparation of consolidated financial statements? At the time of preparation of consolidated financial statements, H Limited will have to reduce its profits. Its profits means when it will prepare the consolidated P&L, from the consolidated P&L, rupees 20 lakhs will have to be reduced. Clear? Clear on this? I think Harish has got the same answer. All right. So now moving on to the part B. So now we are talking about part B, please. Okay. Now, A Limited holds 75% of equity share capital. A Limited purchases. Now, please remember, a holding company purchases inventories costing 150 lakhs from B at a price of 200 lakhs. So now there is a profit of 50 lakhs made by the subsidiary company. Entire inventories remain unsold with the holding company. So in this case, what do you think will be the accounting treatment? Over to you. What do you think will be the accounting treatment? Over to you. Yes. What will be the accounting treatment in part number B? Over to you. Do you have similar type of adjustment in this case? How is that required to be dealt with? Pooja is saying 50 lakhs will be adjusted in the analysis of profits. What do you mean by analysis of profits? And what do you mean by adjusted? So what does adjustment mean here? Yes, over to you. Quickly, in this part B, what is going to be the accounting treatment? What is going to be the accounting treatment in part B? Quickly, what will be the accounting treatment in part B? Over to you. I'm waiting for a response. Huh? So how should, okay, so Nistala has answered this. Nistala is saying 50 lakhs is the unrealized profit and 150 lakhs is the cost of inventory. No, so 50 lakhs unrealized profit and the amount of inventory is known. So what is it that you need to do on this? Is there any adjustment required on this? How should this adjustment be accounted for? Okay, Pooja is saying 50 lakhs will be eliminated by the subsidiary company. Nistala is saying at the time of, I think, in holding company. Nistala is saying in holding company. Okay. So let's get on to this item also. Now, see, in this second situation, once again, we have two companies. Which are those two companies? H and S. Now the goods are sold by S to H. And for the purposes of reference, this has been termed as upward transaction. This has been termed as upward transaction. So this is only the terminology, huh? But conceptually we need to discuss as to how this needs to be accounted for. Now, in this case, again, there is a profit element of 50 lakhs. Yeah, there is a profit element of 50 lakhs. Once again, what do you find? 50 lakhs is the profit. But who has recorded this profit of 50 lakhs? This has been recorded by S now. It is appearing in the books of S, not in the books of H. Yeah, so that's why when the consolidated financial statements will be prepared. When the consolidated financial statements will be prepared, the profit share of S is picked up by two parties. It is picked up by two parties. Which are those two parties? One is H, other one is minority interest holders. Yes or no? One is H, other one is minority interest holders. Because H is not the wholly, so because this is not a case of wholly owned subsidiary. So therefore, this 50 lakhs profit will have to be distributed between H and minority interest. Yeah. So this will get distributed between these two. And from this distribution, what do you need to consider? That A's share of profit from B means its proportionate share, because A holds what? A holds 75% shares. 75% shares. 37.5 lakhs will be eliminated. Why? Because this is unrealized profit. This is unrealized profit. Okay. And remaining 20.5 will go to what? That will go to minority. Okay. Yeah. Then I think I can see this response coming from Harish. Okay, very good. So Harish has answered this. Great. So any questions, any doubts if you have on this, please let me know. Any questions, any doubts, then we'll move further. All right, so I can see some of the responses coming in. Okay, so Sento was saying, since it's a case of upstream transaction in the consolidated P&L, entire transaction of 200 lakhs, of course. So at one place, purchase and sale will be eliminated. But I think we need to be conscious about this unrealized profit, because that is simple and everyone tracks that. Unrealized profit is an important adjustment. Okay, so that also needs to be eliminated in the way we have just discussed. Okay, so now Sitkala has a query. Sitkala is asking, in this question, why did you say it's an intercompany transaction? Because as it is between holding and subsidiary. Yes. See, what do you mean by intercompany? Intercompany means transaction which is taking place between two companies. So company A, company B. That is what you call as intercompany. Yeah. And if these two companies belong to one single group, let's suppose if we say that these two companies belong to one single group, then of course you will call it as intercompany transaction, but you will also call it as intragroup. Intragroup means something which is taking place within the group. Okay, something which is taking place within the group. Yeah, Kiran is saying, sir, what do you mean by upstream and downstream? Very simple. So these are only the terms. So don't get confused by the term. I would suggest you need to just pick up the concept. See, when holding will sell to subsidiary, what will you call it as? Downstream. This is only a nomenclature. But when subsidiary will sell to holding, you will have to call it as upstream. Okay. Does it really matter? No. This is only for the purpose of reference. So it's a term which has been assigned. Conceptually, you need to decide as to how will you eliminate. Okay. Then I think this other query comes from Kiran. Kiran is saying 50 lakhs is reduced full by whom? See, 50 lakhs was booked by subsidiary. Now, please remember, when the subsidiary would have sold to holding. So who would have booked profit on this? Of course, subsidiary. So this profit would have been appearing in the books of subsidiary. And this profit is what? Unrealized. This profit is what? Unrealized. So that means this unrealized profit would have been appearing in the books of subsidiary. So that's why who needs to eliminate this? Subsidiary. Yeah. But while preparing the CFS, this profit of subsidiary will not only go to H, this will also go to minority interest holders. So that is how you need to account for this. When H will sell to S, this element of minority interest will not come. Why? Because this entire profit is sitting in the books of H, and from the books of H, you'll have to reduce this. Okay, clear on this? Then I think this next query comes from Srinivasan. He is asking, sir, as per AS2, we are considering unsold inventory at cost or NRV, whichever is lower. Then why unrealized profit or loss is again considered or eliminated? Because cost or NRV principle you are applying in standalone financial statements. In the consolidated financial statements, that concept is already applied, and over and above that, you are discussing something different. Now tell me one thing, Srinivasan. If let's suppose there is a company A Limited. Okay, this has got 3 branches. Branch 1, branch 2, and branch 3. Say branch 1 sell goods to branch 2. Okay, which at a cost of 80 sold at 100. Now, while preparing the financial statements of A, do you think this profit element of 20 will be maintained? What do you think? Yes, quickly, everyone please confirm. Srinivasan, yes, please confirm. I'm not talking about consolidated financial statements. I'm talking about standalone financial statements. When one branch will sell to other branch at a profit of 20, so do you think while preparing the financial statements of that company, those profits of the branch will be kept? What do you think? Yes, quickly, over to you. Do you think that profit will be kept? Tell me, quickly. Do you think that profit will be kept? Yes, everyone? Kiran is saying no, that will not be kept. Why? Because whenever you prepare at the company level, any of the transactions between the branches will be eliminated. Now, in this case, Kanishka is also saying no, this will not be kept. Now, in this case, will you not say that inventory is valued at cost or NRV, which has already been done? So why don't you keep this profit of rupees 20? Will it be appropriate over there? Tell me, will it be appropriate over there? No. So same is the principle you will consider here. Understood? Yeah. I think same is the response coming from Sayanto, Pooja, Srinivasan, and Unnikrishnan. Hoping Srinivasan, you are clear on this now. Yeah. Okay, so Kanishk is saying that stock reserve or the unrealized profit needs to be eliminated. Okay. Yeah. So that needs to be eliminated. All right. So now what we can do is we can just pick up one more example, and in that example, just a minute. So now we'll pick up one more example. In that example, we'll prepare the consolidated balance sheet. Yeah. So far, we have been discussing about the preparation of the consolidated balance sheet. So now we'll pick up one example and prepare the consolidated balance sheet, through which I'm hoping you should get some more clarity as around some of the concepts that we have discussed. Okay, so now let's move on to the consolidated balance sheet. Now, please remember, in this example, we are not going to look at all of those adjustments that we have discussed. Okay. So there are a lot of adjustments we have already discussed, whether we talk about goodwill, capital reserve, revaluation, minority interest, pre-acquisition profit, post-acquisition profit, okay, eliminations. So there are going to be a lot of adjustments at the time of consolidation. So all of those we have discussed one by one. Now, as a next step, what is it that we are trying to look into? We are just trying to look into the preparation of consolidated balance sheet. Okay. And while doing this, of course, some of the adjustments may be required. Some of the adjustments may not be required. So every time it will not happen that each and every question will have all these type of adjustments. But yes, in most of the cases, goodwill or capital reserve, at least this much portion you should expect. Okay. So that's why I would say this is going to be a very, very common concept which is going to arise in relation to preparation of the consolidated financial statements. Okay. Yeah. So now, whenever consolidated financial statements are prepared, what is the first step that you need to remember? Line by line addition means all the assets of holding, all the liabilities of subsidiary will be picked up, they will be added together, and then all of these adjustments will come in. Whether you talk about elimination or whether you talk about any other adjustment or consolidation adjustments which we have discussed. Okay, so that is how you need to always approach this. Now, in this particular question, you are required to prepare consolidated balance sheet of H Limited and its subsidiary as at 31st March X1 from the following information. So what is the information? We are given balance sheet of H and S. PP is there. Then H has invested in S. Then there is share capital of both the companies. Then we have reserves of both the companies. Then trade payable. And it says H Limited acquired shares of S Limited on 31st March X1 means on the date of acquisition. Okay, means this acquisition has taken place on 31st March, and on the date of acquisition, the balance sheets of two companies are also given to us. These two are also made available to us. Okay, so you can just start solving this. Everyone, I would request that you should start solving this. Please don't wait for my solution or for me to solve this. You should start solving this. I'll also get on to this solution. But before that, if you are done, you can just let me know whether you have solved this or not fully, whether you have been able to draw this complete balance sheet or not. And if at all, you found some adjustments while preparing the consolidated balance sheet. Okay. Yeah. All right. So now, when you prepare the consolidated balance sheet, at the first place, what do you need to find out? Some of the adjustments. Please remember, what are going to be those adjustments? One, goodwill or capital reserve. Okay, so that is something you need to find out. Number one. Number two, minority interest. To begin with, at least these two things you need to always work out. So now in the question, we don't know whether H Limited holds 100% shares or less than 100%. So as a first step, what do you need to do? We'll have to compute that. Okay. Nistalai Singh, is there any minority interest, sir? That is something you need to find out and let me know. Okay, again, I think you are doing the same thing. You are waiting for me to solve this, which is inappropriate. You should solve this question because we have discussed all the adjustments. So that's why now this question is something which you need to solve on your own. And let me know all of these aspects. Huh? Okay. Even if your answer is wrong, doesn't matter, but please attempt this. Please try this once. Okay. Now, in this question, first of all, we need to find out whether the share of H is 100% or less than 100%. Now, H holds 20,000 equity shares of S. 20,000. Okay. And how many equity shares S had issued? 25,000. How do you get to know about it? So, per share is rupees 10 and 2,50,000 is the share capital. So that means all in all there are 25,000 shares. So which means 80% is held by H and 20% by someone else. And what do you call that someone else as? Minority interest holders. Okay, that is what you call as minority interest. Yeah. So that means first point in this question is clear that yes, minority is there. So if the minority shareholder is there, our one step will increase. And what is going to be that step? We will have to compute the amount of minority interest. Why? Because that will also go and sit in the consolidated balance sheet. Okay. So at the first place, what will you do? You will just place the balance sheet. Okay. Structure of the balance sheet you will create. Structure of the balance sheet you will create. Yeah. So now in the balance sheet, what are the components you will pick up? You will have to use this information which is available in the question. Okay. Using this information, you will have to put down the structure of the balance sheet to begin with. And that is when, and after that, you will just pick up each and every question one by one. Okay. Now, when the balance sheet will be put down, you will have to keep this in a very proper format. So we'll say consolidated balance sheet of H Limited and its subsidiary as at this. Please remember the question asks you to prepare consolidated balance sheet. Yeah. So that's why it's very important. That's why it's very important that each and every aspect related to the balance sheet is taken care of by you. Okay. Now, consolidated balance sheet of H Limited. So share capital will be there, reserves, minority interest will have to come in, trade payable. Then on the asset sides, we had PP, so non-current assets, then current assets. And for each and every item, there has to be a note to account. There has to be a note to account. Okay. Now, so at the first place, before we really get on to the computation of numbers which will flow into the balance sheet, at the first place, what should you compute? Goodwill or capital reserve and minority interest. Goodwill or capital reserve and minority interest. Okay, so now how do you get into that? Purchase consideration. Purchase consideration. 2,20,000. Where does it come from? Purchase consideration. Where does it come from? This information is available in the question itself. 2,20,000. From 2,20,000, what do you need to reduce? Net assets. Net assets of the subsidiary. Now, what is going to be the net assets of the subsidiary? It's share capital and reserves. At the time of acquisition, please remember this entire computation will be done at the time of acquisition. At the time of acquisition. Okay. Yeah. So paid up capital was 2,50,000. Reserves were 1 lakh. Reserves were 1 lakh. So 80% of these two is what? 2,80,000. So now in this example, what do you find? Amount paid to acquire the subsidiary is lower than the amount of net assets. So that's why what do you get? Capital reserve. Capital reserve. Okay. Capital reserve. Yeah. So this capital reserve will be taken to the balance sheet. Easy to solve. Okay. Now, can you tell me the amount of minority interest? I think Harish has solved this. Can you tell me the amount of minority interest? Yes, over to you. How do you get the amount of minority interest? Quickly. Everyone, please answer this. Tell me, how did you compute the amount of minority interest if you have computed that? If not, please compute and let me know. I'm waiting for a response quickly. Amount of minority interest. What will be the amount of minority interest? How do you compute it? Over to you quickly. I've received one response so far from Harish. What about others? Preeti is saying remaining 20% share and profit. Okay, very good. Unni Krishna is saying 20%. So that is the percentage. I'm looking at the amount at the date of acquisition as well as the reporting date. So what is going to be the amount? So Vidushi is saying it will be 70,000. Very good. So how do you get this? How do you get this? Once again, so these are the net assets that you have. These are the net assets that you have. 3,50,000 on the date of acquisition. Okay. 80% of these net assets you have taken to holding company. 20% of these belong to whom? Minority interest. So that means minority interest will be what? 70,000. Clear? Yeah. Minority interest will be 70,000. I think Harish has prepared the balance sheet and Harish has shared the total. So he's saying, sir, the total of the balance sheet should be, I think 10,55,000. Is it? Okay, no worries. Great. So we'll look at the solution of, okay. Srinivasan has also solved the amount of minority interest. Preeti has also solved. Very good. Okay. Yeah. So now let's go to the balance sheet. And for the balance sheet, what we will do is we'll just place the numbers in the notes to accounts. Share capital of only H Limited will have to be considered because this has already been adjusted while computing goodwill or capital reserve. Yeah, so in the share capital, what do we have? 5 lakh. In the share capital, we have 5 lakh. And this 5 lakh you will take to the balance sheet. Okay. So you have placed this. The reserves and surpluses will pick up later on. Minority interest, we have already computed. So we can also place this amount over here. Minority interest we have computed. So we can place this amount. I think there is some formatting issue. Yeah. So minority interest is 70,000. We have already computed. Now, next is about the trade payables. So on trade payable, do we have any adjustment? No. So what do? You will do line by line addition. So 1,70,000 and 50,000. Line by line addition you will do. So trade payable, 1,75,000, 50,000. So these two you will add. It becomes 225. So this 225 you will take to the balance sheet. So if you go up to the balance sheet, you will take this. Okay. Then I'm just using the information of the question. Then in the question, there are 3 assets: PPE, investments, current assets. Investments are already adjusted with the share capital of S Limited. So what are we left with? PP, sorry, I think I considered this to be share capital. This was not the share capital. So this was the share capital. Okay, so this we have ignored. So now PP, you will consider both. So 5 plus 3 and current assets 155 plus 1 lakh. Okay, so let's go to the notes to accounts first. So PP 5 plus 3, 8 lakhs. So this 8 lakhs you will place in the balance sheet. Note number 5. Current assets. Again, first of all, you will go to the notes. 155 plus 1 lakh, 255. So this 255 again you will place to the balance sheet. Are we left with any other item in the balance sheet? Yes. Very important item, and that is reserves and surplus. So now let's again go to the question first. So reserves and surplus for holding was 2 lakh, for subsidiary was 1. This one of subsidiary is already adjusted with minority interest while computing goodwill or capital reserve. So what are we left with? Reserve of holding company. Reserve of holding company. So let's go to the notes to accounts once again. So this reserve you will place to the reserve and surplus. So this belongs to H Limited. This belongs to H Limited. And from the working note, there was a capital reserve. So that will again go to reserve and surplus. So this comes from the working note. So all in all, the amount of reserve is what? 2,60,000. This again you will place to the balance sheet. So let's take this to the balance sheet. 2,60,000. So now, after we place all of these numbers, what should you do? You should pray that the balance sheet should match. And let's find out that in this question, does the balance sheet match? Yes. If by chance it doesn't match, and if the time is not there, please leave that question and move on to the next one. Please don't waste time in the exam. Okay, so if the time will permit, you can just come back and check it later on. Okay, Sangeetwani is saying, sir, please explain the computation of percentage of holding. No worries. Let's look at this. I'll have to remove some part. Okay, so now, how many shares are held by holding company? 20,000. Holding company holds 20,000 shares of S. Okay, Sangeetwani, this part is clear. This information is available in the question. This is available in the question. And how many shares does the subsidiary company have in totality? 2,50,000 divided by 10, because one share is of rupees 10. So how many shares are there? 25,000 shares are there. How do you get 25,000? 2,50,000 divided by 10. 25,000 shares are there in total. Okay. So now 20,000 shares are held by holding company out of 25,000 shares. So what is the percentage? What is the percentage? Therefore, it will become 80%. Clear on this now? Therefore, it will become 80%. So Sangeetwani is clear on this. Any more questions? Any more doubts if you have? Kiran is saying, what about share capital? Share capital we have already placed in the balance sheet. Huh? So if you go, every time I was placing anything, I'll just putting a tick mark. Okay. So I've already placed the share capital, and this share capital is the one which belongs to H Limited. Yeah. Remember, this is the one which belongs to H Limited. Why? Because for S Limited, share capital of S is already allocated to holding as well as minority. So that we have already done. Unni Krishna is saying H plus S total in question asset total will match with consolidated balance sheet total assets if there is no revaluation of asset. Not necessarily, and you should not follow any such principle. Yeah, you should just apply the concept that we have discussed over here. Okay, let's not create any such things which you are just trying to look at. Huh? There is no such concept, because a lot of adjustments will come in, eliminations will come in, Okay, so goodwill or capital reserve will come in. So how can they match? They will not match. Okay, Preeti is saying, sir, what if the balance sheet date and acquisition date is different? Absolutely not a problem. On the acquisition date, you will first of all compute goodwill or capital reserve, and it's similar to something which we have done in amalgamation. So in amalgamation, you remember when the balance sheet reporting date was different and the date of acquisition was different. So what do? At first place, you compute goodwill or capital reserve that you carry to the balance sheet. So that is how you will deal with this. Okay, clear? Any more questions around this? Any more questions around this? Yes or no? Preeti seems to be okay. So I'm just hoping that you don't need a break. Huh? Anyways, we have just stretched this a bit, but please quickly confirm. Yeah, please quickly confirm. Should we really continue or you need a small break here? Quickly, everyone. Yes, waiting for your response. Okay, Preeti is saying no break required. What about others? Quickly, Rashmi has a query. Rashmi, I'll come to your query. Just give me a minute. Huh? Okay, Nistala, Sanvitanis, they are saying no break required. So let's continue. Very good. Yeah. Okay, so Uni Krishnan is saying there's no question. Nistala is saying please explain capital reserve. See, capital reserve is the same way like we have discussed goodwill or capital reserve in most of the questions. Every time you have a purchase consideration, from the purchase consideration, what do you need to do? You need to reduce the proportionate amount of net assets. And how do you get net assets? Equity share capital plus reserves. Okay, so that is something you need to perform. Okay, Kiran is saying, please explain minority interest computation. Minority interest, once again, you will do the same thing. Net assets you will compute. Share capital plus reserves. Okay, proportionate amount of that. What is the proportionate amount? 20%. So share capital plus reserves, total of these two into 20%. So that is what you get as minority interest. Clear? Yeah. Rashmi is saying that this question only 20% invested. Then how to apply this standard? No, I think you are mistaken. 20% was the amount of minority interest. 80% was the amount of, 80% was the share of holding company. 80% was the share of holding company. Okay. Rashmi is saying no break, we should continue. Harish is saying we should continue. All right. So now, see, as far as consolidation is concerned, we have discussed a lot of situations, a lot of examples, a lot of adjustments. As we discussed that consolidation is not only about the subsidiaries, but consolidation is also about the joint ventures, which is in the form of another type of arrangement that we are going to discuss, and that will also include associates. So what I'll do is I'll just move on to the next accounting standard, which is about joint ventures particularly, and we'll just look at as to that arrangement, and we'll also look at as to how consolidation is required in respect of joint ventures or jointly controlled entities, and then we'll pick up associates. And after we are done with all of these three, we'll also be discussing some more questions around the consolidation in totality. Okay, yeah. So now as a next step, I'm just moving on to AS27, but please remember that we are still on consolidation. We are not yet done. Okay, so consolidation is something which will continue. And before I move on to that, I can see this question coming from Uni Krishnan. So he's asking, sir, for minority interest, capital reserve is available in S Limited. Will that be considered or not? No. Please remember that minority interest you will compute on the date of acquisition. Okay. And minority interest will pick up the reserve. I think let me just explain this point with the help of some working up. I think you're slightly confused on this point. Now, please remember that let's suppose there is a company H, okay, and it has got a subsidiary S Limited. S Limited has got net assets worth of 100. Net assets worth of 100. Okay. So now, when H will acquire S, say he has acquired 80%. Okay. So now what will happen? There will be another party, minority interest, who will hold 20% of S. Okay. Now, when this acquisition will take place, say this is the date when this acquisition has taken place. Now, up to the date of acquisition means for this period, or up to the date of acquisition, the net assets of S Limited were what? 100. Now, on the date of acquisition, what is it that you are required to do? You are required to allocate this 100 into two parts. Obviously, you will allocate this into two parts. 80 you will give to H and 20 you will give to minority interest. Now, when you give 80 to H, at that time, what will H do? H will say that for acquiring S Limited, I had paid 90 rupees. Let's suppose H had paid 90 rupees. And against this 90, H received 80. So that's why, what does H compute? H will say, I have paid in excess of what I have received. So that is what you call as goodwill. Or if let's suppose H had paid only 70. So H will say, I had paid only 70, but I received net assets worth of 80. So that's why 20 is the amount of capital reserve for H. Is the amount of capital reserve for H. Now this 10 has got nothing to do with minority. Please understand. Unni Krishnan, are you clear on this now? This 10 has got nothing to do with minority. Why? Because minority has already received its 20. Out of this 100, minority has already received its 20. Clear on this? Unni Krishnan, please confirm. Clear on this? Yeah? Waiting for a response quickly. Please confirm. Any more doubts if you have on this one? Quickly. Any more doubts on this? Unni Krishnan, clear? Yeah? All right, great. Unni Krishnan is asking, but sir, if the capital reserve already existed in the books of S Limited on the date of acquisition, see there again, you need to understand. So if this reserve would have existed, what do? You will have to consider your total net assets. Okay. If that form part of your net assets, obviously that will also get distributed. Clear on this? Yeah. All right. So now moving further, we will now be discussing joint arrangements, okay, which is about AS 27. Now, joint arrangements are of three types as per AS 27. Or you can say there are broadly three types of arrangements. There are broadly three types of arrangements. Now, this terminology I'm using because it's an arrangement, okay, which have been discussed under AS 27. Jointly controlled operations, jointly controlled assets, jointly controlled entities. Before we really get on to these three types of arrangements, let us try to understand what do you mean by a joint venture to begin with. Yeah, what do you mean by a joint venture to begin with? Okay, so now this part is very important and I would say very interesting also. So we are now talking about a joint venture. See, sometimes what may happen is two investors may come together, say A Limited and B Limited. Please remember, these are two investors. We are not saying two companies have come together and formed a company. So even if these are companies or even if these are individuals, we are talking about two investors. Let's suppose A and B come together and they form a company, say AB Limited. Okay. Now, what is the purpose of forming AB Limited? Now, I'm not saying A will come to an end or B will come to an end. A Limited will remain, B Limited will remain. Because these two are investors. So you can say these two are investor companies. If let's suppose they come together and form a new company, in this case, when they form this new company, what is going to be the objective? Let's suppose A and B want to pool resources. They have got common resources, they want to pool resources. Or let's suppose they want to expand. Okay. Or let's suppose they want to leverage in terms of one investor. Let's suppose A has got technology, B has got resources. So they want to come together so that both of them can get the advantage from each other. Okay. So now I'm just trying to explain you that there could be various reasons why these type of collaborations may happen between two investors, because of which they may want to come up and create a joint venture. Okay. Now let's suppose two investors have come together and they have created a joint venture. And let's suppose their shareholding is what? 50% each. Both of them hold 50% shares of AB Limited. Now, for this AB Limited to be called as a joint venture, there are a couple of conditions which are required to be fulfilled. One, there has to be a contractual arrangement. There has to be a contractual arrangement between A and B. Now, in respect of this arrangement, there must be a contract between A and B. Okay. And through that contract, there must be a joint control of A and B over AB. Now, this is very, very important part. A and B should have joint control over AB Limited. Now, let us try to differentiate this from the case of holding and subsidiary. Okay, so first of all, I'll just try to explain you about holding and subsidiary. So say there was H Limited, this was S Limited. H Limited holds 90% shares and there was minority interest which holds 10%. In case of holding and subsidiary, H gets control over S Limited. H gets control over S Limited. Or you can say this is unilateral control. This is unilateral control means only H has got control over S Limited. Minority interests do not have control. They hold shares of S Limited. There is no doubt about it. But they don't have control over S Limited. Okay. So now, what does it mean? What does it imply? It means that tomorrow, if any decision is required to be taken in respect of S Limited, then who will have the authority? Who will have the authority? It will be H Limited. It will be H Limited. Authority will always be there. Means who will direct that this decision is to be taken. Okay, this particular activity will be performed. If let's suppose a decision has to be taken, then who will be the ultimate authority? H Limited. That is what you mean by control or unilateral control. In this example also, there are two investors. Who are two investors? H and minority. Both of them are investor. But the problem with the investor MI is what? So problem with this investor is what? This investor doesn't have control over S. Okay. This investor doesn't have control over S. Yeah. Now, let's try to differentiate this from what we have just discussed. Now I'm coming back to joint venture. Okay. Now I'm coming to joint venture. Let's try to differentiate this arrangement of A and B with that of H and MI. In this particular case, when we say that A and B have got joint control, please remember, joint control. So this means that both A and B are going to be the decision maker. Both of them will have authority in terms of taking the decisions. And both of them will have equal authority. Equal authority means if any decision is required to be taken, if let's suppose any decision is required to be taken, then consent of both A and B will have to be taken. Only then such activity will move forward. Otherwise not. Let's suppose a director is required to be appointed. Say in respect of AB Limited, a director is required to be appointed. Then who will decide this? Is it only A or only B? No. No. It will have to be both A and B. Consent of both A and B will be required, which is also called as unanimous consent. Or decision making has to be based on unanimous consent. Means consent of all the investors. In our example, we have only taken two investors. If let's suppose these are three, then consent of three will be required. Okay. And it doesn't matter if let's suppose instead of 50-50, they hold 45-55. They hold 40-60. It doesn't matter. Why? Because they have a contractual arrangement. And what is this contractual arrangement? That contractual arrangement requires unanimous consent. That contractual arrangement requires unanimous consent. This is what you call as joint control. Okay, this is what you call as joint control. Understood? Yeah. Only and only when there is a joint control, such an entity will become joint venture. So in this example, what do you call AB Limited as? This will be called as joint venture. This will be called as joint venture. Okay. A and B will not be called as joint ventures. They are the investors. Joint venture is what? AB Limited. Clear on this? Yeah. This is a very, very important aspect of this particular accounting standard. or you can say our understanding of the joint venture. So if you have any questions, any doubts around this, please let me know. Over to you. Any questions, any doubts if you have around this, please let me know. Over to you. Yes, quickly. Any questions if you have, any doubts if you have around the understanding of joint arrangement, this joint venture. Tell me, everyone. Srinivasan is asking, sir, why we require a separate consolidation for joint venture or associate? See, we don't require separate consolidation. Consolidated financial statements will be only one. You can just simply say that the consolidation procedures or the accounting treatment which we follow for JV and associates is different from the subsidiaries. And that is because of the fact that in respect of subsidiary, there is a control, but in case of joint venture, there is joint control. Okay. Nistala is saying reason of JV, sir, only two reasons. No, so we have not discussed about reasons. I've just discussed about the features, about the conditions. So if you are thinking that these are the reasons, these are not the reasons. I'm saying these two criteria will have to be fulfilled always for a venture to be called as a joint venture. Preeti is saying, sir, in joint venture, shareholding is necessary. Yes, of course. Shareholding you will generally find. Yeah, of course, shareholding. But I'm saying equal shareholding is not necessary. Kiran is saying, what could be the object? Object could be to leverage on different resource base. Okay, to expand. Maybe one party has got money, funds, other party has got the technology. So that is how they may come together. Okay, there could be various reasons. All right, what about others? Quickly, any questions, any doubts on this? Quickly, please confirm. Any questions, any doubts? Srinivasan is clear on this. All right, so now what we will do is we will move on to the types of joint ventures. As we discussed, there are three types of joint ventures: jointly controlled operations, jointly controlled assets, jointly controlled entities. For all these types, please remember that they are types of joint ventures. So which means that for all these types, those two conditions will become mandatory. What are those two conditions? One is a contractual arrangement and second, joint control. Means joint control has to be there. Only then it will be considered as a joint venture, irrespective of the type of joint venture it is. Okay. Preeti is saying, sir, then can we consider it as a prototype of partnership? So you can always say that it's a kind of partnership only, but it's a structured partnership. Okay, so definitely it's a partnership. Yeah. So now moving further on to jointly controlled operations. Now we will be discussing about jointly controlled operation. And with the help of some examples, we'll also be trying to understand more about jointly controlled operations. So now what is the feature of a jointly controlled operation? Each venturer, now who is the venturer? When A and B come together and form AB. So AB is what? JV. And A is called as venturer. B is called as venturer. Okay, so each venturer has his own separate business. There is no separate entity for JV business. So let's suppose two venturers have come together, but they don't create a separate entity. So they collaborate. So they collaborate, they enter into an agreement, but a new entity is not created. Okay, new entity is not created. So what do? Those venturers are creating their own assets and maintain them. So A has got assets, maintaining them. B has got assets, maintaining them. Each venturer record only his own transactions. Yeah. No separate books of accounts of JV business are maintained. There is a common agreement. This has to be there for sure. venturers use their assets. Now, why they have come together? They have come together for a purpose. Let's suppose they want to pick up a project. Okay, so let's suppose there is a government tender which has come out, and for which some assets are required, some resources are required, which they will be able to manage only when they come together. Individually, A is not able to handle that project, B is not able to handle that project. So that's why A and B want to come together. So they want to use their assets for that particular business. So that particular business will be in respect of JV business. Okay, why? Because it's related to their venture. So venturers will meet their liabilities. Okay, so they will have their liabilities. They will meet the expenses of the JV business from their own funds. And revenue which gets generated from this JV business, or any income which gets generated from that JV business, what will happen to that? That will be shared by the venturers. That will be shared by the venturers in the ratio which they will agree. Now, this is something which we call as jointly controlled operation. Jointly controlled operation. So now I think the best way to understand this jointly controlled operation will be to get on to one example. Okay, so what I'll do is I'll just move on to one example through which we will try to get some more clarity around jointly controlled operation. Okay, just give me a minute. So let me just open that example. All right. So and I think in the meantime, if you have any questions, any doubts, just feel free. Yeah. So alongside, we'll also be solving such type of questions. Okay. So now A, B, and C enter into a JV arrangement to purchase a land, construct and sell flats. Okay. Now, in respect of this, Mr. A purchased a land for 60 lakhs on 1st January 2000X1. And for the purpose, A took a loan from a bank for 50 lakhs at the rate 8% per annum. A also paid registration fees of 60,000 on the same day. B. Now, what did B do? B supplied materials for 4,50,000 from his own godown, and he purchased materials for 5 lakh for the JV business. Okay, so I'm just segregating the roles of A, B, and C. C met all the expenses related to advertisement, labor, other incidental expenses, which turned out to be 9 lakhs. Now, on 30th June 2000 X1, okay, on 30th June, what has happened? Each of the venturer agreed to take away one flat. So what was the objective? That they will construct. What was the objective? They will construct and sell flats. So now on 30th June, what do they do? Each of the venturer, means A, B, and C, each take away one flat, okay, which they have constructed. And when they took away one flat each, they valued it at rupees 10 lakhs each, okay. And rest, means remaining flats, were sold by them. So A sold that for 40 lakhs, B sold that for 20 lakhs, B sold that for 20 lakhs, and C sold that for 10 lakhs. Okay. Loan was repaid on the same day by A. Why? Because A took the loan. If you remember, A took the loan and this was repaid by A along with interest and net proceeds. Now, please understand net proceeds. Net proceed means from the sale of flat. Any net proceeds which remained were shared by partners equally. Okay. Now, in this case, you are required to prepare draft consolidated P&L. Number one. Number two, you are also required to prepare JV account in the books of each venturer. So you'll not only prepare consolidated P&L, but you'll also go back to each venturer, books of A, books of B, books of C, and in their books, you will record all of these transactions. So now what is the case? So this is a case of jointly controlled operations. And we'll discuss. So once we are done with jointly controlled assets, once we are done with jointly controlled entities, we'll come back as to why do you call it as jointly controlled operations? Because in this case, three parties have come together for a project, but they have not formed any separate entity. Yeah, so that's why it's a jointly controlled operation. Okay, so let's get on to this solution. Yeah, so let's get on to this solution. Yeah, so now in this case, at the first place, what do? You will prepare draft consolidated P&L. Now in the draft consolidated P&L, what do you record? Sale. Yeah, so first of all, record the sale. So A sold the flat for 40 lakhs. B sold the flat for 20, C for 10. So sale has been recorded amounting to 70 lakhs. Then please remember that other than the flats which they have sold to the outside world, they have also purchased flat at 10 lakhs each. So that will also be a sale for the JV business. For the JV business, it's a sale, whether this sale is to the JV partner or to someone else. Okay, so this is also a sale amount, 30 lakhs. Okay, now these are the sales which have got generated. Now let's look onto the cost. Now they purchased land. So if you go back to the question, they purchased land. Now A may have purchased this, B may have purchased this, C may have purchased it, but now we are looking at it collectively. So when we'll go to their respective books, we'll also look at it individually. So now A purchased land for 60 lakhs. So this will become the cost. A also paid registration fees, 60,000. B supplied some material and purchased some material for the JV business. If you go back to the question, you will find that B supplied 4,50,000 his own material, 5 lakh purchased for the JV business. So 9.5 lakh is the amount for the material which has been spent. Yeah. C incurred various expenses. C incurred various expenses amounting to what? 9 lakh rupees. C incurred various expenses amounting to 9 lakh rupees. Okay. And on the top of it, A took a loan. If you remember, A took a loan. What was the amount of the loan? 50 lakhs at the rate 8% per annum. And this business continued for 6 months. So can you tell me the amount of interest which will become payable on this? Over to you quickly. What is the amount of interest which needs to be considered here? On this loan, what is going to be the amount of interest? Over to you quickly. Please compute this amount and let me know. Yes, quickly. Preeti is saying it will be 2 lakhs. Yes. So now this 2 lakhs, where do you record? This will also go to the P&L. Yeah, so this will also go to the P&L. Okay. So now after this, if you compute, if you do this total of sales, so can you tell me the amount of profit which gets generated in the JV business? So the sale value is what? 70 lakhs plus 30 lakhs, 1 crore. From 1 crore, if you deduct all of these expenses, what will happen? There is a net profit. Net profit. So this is the balancing figure. This is the net profit amounting to what? This is the net profit amounting to 18,90,000. Okay, 18,90,000. Yeah, which will be distributed amongst 3 partners, A, B, and C equally. Which will be distributed among 3 partners, A, B, and C equally. All right. Everyone clear on this? Any questions on this quickly? Then I'll get on to the books of JV partner also individually. But before that, if you have any questions, any doubts around this, please let me know. Over to you quickly. Any questions on this? Any questions, any doubts? Everyone clear on this? Okay. Preeti is asking, sir, the profit sharing ratio is always equal. No. See, this is something which the question will specify. If the question is silent, then you will take it as equal. Santa is clear on this. What about others? Just tell me, what about others? Any more questions? So far, we have already solved this question partly. We have already looked at the consolidated JV P&L. Okay. Sitkala is also clear on this. Okay, great. So now, let's move on to the books of JV partner. Now, please remember that when we move on to the books of JV partner, we are not looking at the consolidated picture. We are looking at A separately, B separately, C separately. And we are looking at standalone books of A, standalone books of B, standalone books of C. Clear on this? Yeah. So that is how you need to approach this. So now what we will do is we will have to just allocate all of these amounts, all of these transactions in the books of A, B, and C. So now, let's go to the books of A first. A will say that through this sale, he has got an amount of 40 lakhs. Flat he sold. Okay. And one of the land and building which he received, so this will also get credited to the books of A. So this is getting credited. Why? Because his resources are increasing. Okay. All right. Now, A took a loan. So that's why A will increase its liability. A will increase its liability. Bank loan of 50 lakhs. And A used this amount. A used this amount. Okay. For purchase of land, 10 lakhs. For purchase of land, 10 lakhs. Registration fees he paid. Registration fee he paid. Yeah, 60,000. Bank interest again was paid by A, 2 lakhs. And A received a profit from the JV business, 6 lakhs 30,000. Yeah, 6 lakhs 30,000. All right. So now this is partly completed. Now same accounting entries will also post in the books of B and C. Why? Because at the end, their bank balances should become zero. Okay. Yeah, because net proceeds, they will share equally. So let's go to the books of B. So B will say bank received 20 lakhs from sale. Land and building he received for 10 lakhs. Purchased material for 4,50,000. Okay, which is material supply. Then bank he paid out for purchase of material again 5 lakh. And the profit he received from the JV 6 lakhs 30,000. Now, again, we'll leave the books of B and this adjustment entry also. Now we'll move on to the books of C. So C will again do the same thing. One is sale of flats 10 lakh. Land and building which was taken over for 10 lakh. Okay. Then miscellaneous expenses incurred for 9 lakh. And JV profit he received for 6 lakhs 30,000. Now, let's close the books of A, B, and C. So what will you find? That A has got some funds to be received. Why? Because there will be a shortage on part of A. So when you will close this books, B and C will have excess, and that is apparent from this account of B, from the account of C. So now what will happen? If they will have excess, whom they will pay this amount to? They will have to pay this amount to A. So this amount will again be paid to A. Yeah. So this will go to A. This will again go to A. All right. Yeah. So if this goes to A, so you will take this to this account. This again will go to this account. So now if you place all of these amounts in the books of A, so A will say received from B, A will say received from C. So with this, what will happen? Account of A will also get settled. It will become zero. At the end, please remember that because each party is contributing equally, they are giving equally and receiving equally. So that's why their accounts have to become zero. Their accounts have to become zero at the end. And that is something which we could also see as getting achieved in this. Okay, clear on this, everyone? Any questions, any doubts on this? I can see one question coming from Srinivasan. Srinivasan is asking, sir, in the books of A, please explain how the amount of purchase of land is derived. Very simple. Let's go back to the question. A purchased land for 60 lakhs. Clear? Yeah. Now, for this purchase of land, A took a loan of 50 lakhs. Means for this purchase of land, 50 lakhs come from the loan. So where does this balance come from? Obviously, A will have to pay this out of his own pocket. Yeah. So that's why when you go to the books of A, what do? You will say that land is purchased for 60. 50 comes from the bank loan and 10 comes from his own bank balance. And both of these amounts are in respect of what? Purchase of land. So if you take the total of these two, you will get 16. Okay, Srinivasan, clear on this? Yeah, Srinivasan, clear on this? Everyone clear? Any questions, any doubts if you have on this, please let me know. See, this was the accounting requirement in respect of jointly controlled operations. So we have looked at the accounting in the books of JV business. But please remember, JV is not a separate entity. So only for the purposes of this settlement, this consolidated P&L has been prepared. Okay, Nistala is also clear on this. And in the books of JV partner, their individual entries will be recorded. Okay, clear on this? Yeah. Everyone, please confirm quickly. Yeah. And please remember that we are not yet done, though we are just approaching towards the closure of today's session. We are not yet done. In the next session, we will continue with this accounting standard. And in the next session, effectively, we'll be continuing about the in relation to consolidation. So we'll be discussing associates also, and we'll be discussing this consolidated financial statements also. Okay, so we are not yet done. So in the next session, this consolidation is going to continue. So I can see some of the questions coming in. Sento is saying, yes, it's clear. Preeti is saying, what if the loss is incurred? Absolutely not a problem. So let's suppose instead of profit, if there is a loss, so what will happen? Say if there was a loss of 18,90,000, then you will take it to the respective partners' books. Then each partner will say, so this is by losses. So you'll allocate to all of them A, B, and C, whatever is their amount individually. Yeah. So whether it is loss or profit, it doesn't matter. When these partners have come together. I'm calling those as partners because these are venturers and effectively they are the partners. When they have come together, so they will share profits as well as losses. So they will do both the things. Okay, clear on this? Everyone? Yeah? Everyone clear on this? Preeti Singh in the books of Partners Impact. Again, see the way you have taken the profit. Now, in the books of partner, the way you have taken the profit. So let's suppose instead of profit, it's a loss. What will you do? You will take the loss. Okay, you will take the loss. As simple as that. So that will also move. That has to move to the books of the venturers. Otherwise, their books will not get completed. Okay, Sento is giving the same answer. Srinivasan is also clear on this. Yeah. So I think with this, we are done and we can just conclude our discussion for today. I think Kiran has a question. Kiran is asking, interest on loan kaise aaya? Interest on loan aaya because it's specified in the question. So if you look at the question, it says 50 lakhs loan is there, 8% is the interest rate. So that interest will have to be computed. Okay, so that is how it's there. So you'll have to read each and every information. See, that is the problem you face in exam. You will have to read each and every information of the question very, very carefully. Otherwise, you will miss out. So just because its amount is not given, that doesn't mean you will not record it. Okay, so whether the amount is given or not, it doesn't matter. Preeti Singh said the loan burden in case of loss is solely borne by A. No, no. And that is why you see when the accounts of B and C have been closed, they have contributed to A. Can you see that or not? Yeah. So it's been borne equally by them. And in fact, if you look at the building which was sold by A, that was of higher value. So this apportionment has been done accordingly. Otherwise, what will happen? Otherwise, it will not be an equal share. Okay. Clear? All right. So with this, we can just conclude our discussion. I can see some of the queries coming in. So Preeti is clear. Yeah. Okay. So Manav is saying, so one of the venture has borne major expenses. So he's come. Yes. Yes. Absolutely correct, Manav. Yes. Yeah. So thanks everyone once again for your time and for your wonderful participation throughout this session. Thanks so much. And please remember in the next session, we'll continue. So please make sure that both these things which we have been discussing, okay, AS 21, 27, you revise and come prepared with that, okay, including AS 23. Okay, in the next session, again, we may also pick up consolidated financial statements AS 21. So just come prepared with everything. All right. Yeah. Thanks so much.